Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 88 of our YouTube channel and podcast, and I could not be more excited to continue talking with you guys about personal finance topics that I think could be particularly useful to you guys in your long-term financial journey. Today, what we're going to be talking about is COVID-19 and the impact that it has had on your investments. I know the past couple of days we've talked about COVID, we've talked about COVID and unemployment, and we've talked about COVID and the stimulus checks and the enhanced unemployment benefits, but I really want to zero in on its impact on your investments thus far, moving forward, all of the above. And so let's look at that today, and maybe it will inform you a little more about how you should view investing, especially amid a crisis. Before we get started though, go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below as we go through this episode. If you're listening on Apple or Spotify podcasts, thank you. Just subscribe and leave me a review on either one of those platforms. Follow me on social media, all the major social media sites at MNO with Dylan. And that'd be a good follow for all of you who are interested in the content that I put out day after day. And then if you want to work one-on-one with me, if you want to build a relationship where I can help you work through a financial plan that is specifically tailored to you and your life, then go to my website, www.mnowithdylan.com, click on the Work with Dylan tab, and pick the financial coaching session type that would work best for you. Now, before we get too far in today, what I want to do is I want to recap for you the performance of the stock market this year, and specifically in this past month. So this year, the S&P 500 has increased by over 11% year to date. 11%. Its annual average over the last 100 years, since 1920, has been just over 10.5%. So this has been, to this point, an above average investing year for those who own the S&P 500. And that's wild to a lot of us because we're thinking like, how could it be an above average investing year when we had a huge crash, right? And for those of you who don't know, we did have a very large crash at the end of March. The stock market fell by over 30% from peak to trough. And now, this may make you think, how could we have had a 30% decline in the stock market and still be having an above average year? Well, the stock market and the companies that are in the S&P 500 have been extremely resilient. And obviously, many people will say this and make this point, and I tend to agree, that the stock market and the companies that make up the S&P 500 and the Dow Jones, they are not indicative of the economy as a whole. Yes, they are some of the biggest companies we have. Yes, they are some of the companies that are going to provide some of the most value to our economy, but it is not the economy as a whole. It is not indicative of unemployment. It is not indicative of what's going on with small businesses. It's just not. And so I do want you to keep that in mind throughout this episode, that even though the market has done extremely well this year, it is not 100% indicative of what our economy is doing in response to the COVID-19 pandemic. So not only has the market as a whole done well for the entire year, this past month, November, has been the biggest contributing factor to that. We have just come off of the best November that the stock market has ever had. The S&P 500 increased by almost 10% in November alone. So that tells you that most of that gain that we see has been in November. But anybody who follows the market knows that in January, February, we were hitting market highs every day. And then, like I said, we had over a 30% drop in March. Well, that means from that 30% bottom, we had to get back to where we were in January, February, early March, and continue upward. And so we've spent a lot of the year trying to just get back to where we were. And then we have now eclipsed that by the 11 or so percent that we were up for the year. And November did a lot towards that annual return. But what does this tell us as investors? Why is it important to know? Why is it important to know what has happened in the market this year? Why is it important to understand that we are still having an above average year even amidst a pandemic? Well, first and foremost, the reason that it is important to know that is so we can have calmer demeanors around crashes. And I've talked in depth previously about crashes and how we should react to crashes and the impact that crashes actually have on the stock market. But we have to understand that even since a crash has occurred this year, we're still having an above average year. And why is that? Like I've said previously, the market and the companies in the market are extremely resilient. They bounce back. They come back. It's just the case. It's just how things tend to happen. You have to think about the companies that are the biggest that make up the S&P 500 and the Dow Jones and the NASDAQ. I mean, we're talking about the Apples and the Amazons and the Googles and the Facebooks and the Berkshire Hathaways and those companies of the world. They're huge. They're diversified. They're very resilient when it comes to bad things occurring. And so those companies keep growing even out of something as dramatically bad as the economic shutdown and as the coronavirus pandemic as a whole. Now, it's also important to understand the historic returns of the stock market and what the stock market has done in bad years or seemingly bad years like this year. It has seemed to be a horrible year because of COVID-19, and yet we've had an above average market year. And it's important to understand that. Why? Because a lot of people sold all their investments in March. A lot of people went to cash as the market was falling or when the market was at its bottom. A lot of people sold their investments. And we've talked before about just the reasons that we shouldn't do this. I mean, this is one of the cardinal sins of investing, one of the things that you should never do. And yet people don't have the mental capacity, they don't have the emotional maturity to step into this place and say, even though the market's falling, I know it will come back and stay invested or continue to invest. And so a lot of people sold out. Well, a lot of people sold out, and from the bottom, I mean, we're up now over 40% from the bottom. That's fantastic returns that you missed out on. And so this is just a direct example of why we don't want to jump in and jump out of the market. We want to play for the long term. You know me, I have a long-term viewpoint, and especially in investing, you have to have a long-term viewpoint. And this year has been just, example number one as of why that is. Because if you just had a short-term viewpoint in March, you would have thought everybody's going to die because of this pandemic, and the market's going to go to zero, and just it's the worst thing that could ever happen. But if you would have kept a cool head and continued to invest, or maybe even invested some more as the market dropped, you would be a very happy camper, as I am admittedly at this point. I'm a very happy camper. Why? Because as the market fell, what did I do? I invested more. I put in larger lump sums of money. My wife and I invested more. And so at this point, we've made great returns from the bottom of this market. And not to mention, we've seen our investments that we've had since the beginning of the year increase in value since the beginning of the year. Why? Because we've seen that 11% increase in the market and that bounce back of the stock market as a whole. So all you need to understand is that it is illogical to sell out of your positions as the market drops. It makes no sense. And we don't want you to do it. I want you to be the beneficiary of stock market returns. I want you to sit around and go, I was able to keep a cool head and I made money. I know it's scary. I know it seems like everything's going to go to zero, but look at history. Look at what the market has done historically, and you will be informed it is not going to go to zero, and you will be okay. You will make money over the long term. Just have that viewpoint and continue in that way, and don't be rocked by short-term fluctuations. Now, as I mentioned earlier, a lot of the stocks and a lot of the companies that have allowed the market to be so resilient this year are those who thrive when individuals are staying at home. Because what have we had to do for most of this year? We have been implored to stay at home. And given that that is the case, the Facebooks of the world are going to do well. The Googles of the world, the Amazons of the world are going to do exceedingly well. And given that is the case, then the question naturally comes, well, then should we be only investing in companies that are good when we stay at home? Should we just be focusing on this stay at home investing style or whatever? Or even more broadly, should our investment strategy change because of COVID-19? Well, broadly, the answer is no, and let's dig into why that is. What we have seen in the market this year is these big stay-at-home type companies have done exceedingly well. We saw Zoom off, right? It took off this year, right? The stock took off and made their investors a lot of money. And even those who may have even seemed to get in late, they've still made fair returns because that has been a particular software that many have used, I've used, and just about everybody that has a job or goes to school or anything like that has used over the course of this year. And given that is the case, then it's like, should we invest in all companies like this? Well, no. And why? Because if we change our investment strategy in response to something specific that has occurred, because this has forced us into our homes, it has forced us to stay at home and use companies like Zoom a lot and use companies like Amazon a lot. Well, what happens when we all go back to work? And I'm not saying that this is going to be just all at once, but what happens when everybody's back outside, everybody's back outside of their home? What happens when people are going to restaurants en masse? What happens when everything is open and there are no restrictions? Well, what happens at that point is that you will see companies that did not fare well when everything was stay at home and all the stay at home stocks were doing well. You're going to see those companies do exceedingly well. And so the whole idea here is that we don't want to jump into a very specific investment strategy just because something has occurred. I understand if you're out there buying individual stocks and you see, that there's this shift in consumer behavior, this shift in consumer ideology that you can make a lot of money from, by all means, I completely understand. And do I also understand that we're going to be working from home a lot more now, even when things are able to be opened back up? I completely understand that. But if you're an investor who buys funds, and you hold diversified groups of stocks and bonds and different types of investments, and you just are feeding those investments systematically, then you shouldn't be going about trying to follow the trend. You shouldn't be going about trying to change the way that you invest simply because you've seen something occur in the market. You should continue with your process. If you're just a person who buys index funds or mutual funds in your 401k or your IRAs or whatever, this year should have done nothing to the way that you invest. You should have continued to feed your investments over time. You should have, had those paycheck deductions continue in your 401k. You should have continued with the automatic drafts into the mutual funds in your IRAs or the index funds in your IRAs, and just continued to build the money in your accounts and not cared about the short-term fluctuations of the market. But some individuals saw that, Amazon's taking off, and they'll sell things that they own in their investment accounts and go buy all Amazon stock or go buy all Zoom stock because that's the next big thing. It's very easy out of a crisis, out of a crash, to want to follow the money. It's very easy to want to follow the gains. But the problem is, a lot of times when you are trying to follow gains, you're going to fall behind the gains. And that's not to say you won't make any money. A lot of people who looked up and said, Zoom is legit, after Zoom had already increased in value quite a bit as a stock, still made a lot of money. And same thing with Amazon, same thing with a lot of these stay-at-home type companies that did exceedingly well. But you can also find yourself in a place where you were late to the game and you could have made better returns by staying with your process, staying with your strategy. Not to mention, a lot of people end up taking on crazy amounts of risk by buying just some individual companies that did exceedingly well instead of remaining diversified, remaining with their asset allocation that they had or whatever it may be in their specific situation. They throw risk out the window to try to chase the returns out of the market. And that's no way to go about it either. You want to continue with your process. We know that long term, if you are buying the S&P 500 every month and just feeding it, and then when the market drops real hard, if you want to put more in, that's a good idea too. And as you continue over time doing that, you are going to make a lot of money. Continuing with your particular strategy, understanding what your strategy is, not just having a haphazard way of looking at your investments, having a strategy, understanding what you plan to do month after month, week after week, however often you are systematically investing is extremely important, because then you can just follow that plan and know that, the market's going to go up, the market's going to go down, but we still have to continue the plan, and you'll be a great beneficiary of lots of gains over time if you were to do that simple task. So some of you may be asking, well, then moving forward, Dylan, we've had an above average year. Well, moving forward, wouldn't you expect us to have, worst years ahead? Well, not necessarily. Look, I am not in the business of market predicting. I am not trying to predict what is going to happen in the future with my own investments. Yes, I am going to invest in some individual stocks in my own portfolio that I believe have had good track records of creating profits and creating value for shareholders, and I think they'll continue to innovate and do that into the future. Yes, I've done that, right? But that's not a huge part of my portfolio. The huge part of my portfolio are large diversified groups of American companies. And that gives me no reason to look and go, well, what's the stock market going to do next year or the year after? Or, should I be invested now or invested later? No. Once again, you need to follow your strategy. You need to continue to stay invested. Do not jump in and out and in and out. That is the easiest way to not make money in the stock market. The easiest way is to always stay invested, always be fully invested in your particular strategy, in your particular asset allocation, in your particular diversification strategy, and just pour money in. All I can tell you is that I know what history says. History says that the S&P 500 has gone up over 10% per year. That sounds like a good plan. That sounds like something that I want to be the beneficiary of, and not just sitting around and trying to figure out what the next move is. That is not worth your time. That is not worth your energy. What is worth your energy is determining, what are good mutual funds to be invested in, what are good index funds that I should put my money in that have low expense ratios, that have had good long track records of increasing in value over the long term. We don't care about 1 year. We care about the long term. We care about what things are going to do over time, not what they're going to do next year. So quite simply put, I do not care what the market does next year. I don't care what the market does next week. I don't care what the market does tomorrow. Is it interesting to keep up with it day by day? Yes. Is it interesting to keep up with it, over the years and over the months? Sure, right? But we want long-term historical evidence of what should occur. We don't care about short-term. 1 year is even short-term. Okay, we care about 5 years, 10 years, 20 years, 30 years, 40 years, 50 years. I even gave you the average of the S&P over 100 years, right? Because that gives you the long-term viewpoint of what is going to occur or what has occurred in the past. I'm not saying that what has happened in the past is going to be what happens in the future, but it can be pretty indicative of what we can expect. And so, I just think that many of you are going to be better served if you turn off the news. I think you're going to be better served if you stop paying attention to the movements of the market day by day. I think you're going to be a lot better served if you are better informed about the historical data on the market and how crashes have not been the end-all be-all, and how individuals who sell during crashes do not end up making a lot of money. They do not end up being the individuals who win when it comes to their money, when it comes to their investments. Those are not the winners. The winners are those who ride it out and continue to put money in and continue to feed their investments, feed their mutual funds, feed their index funds, buy individual stocks that have good long-term value, and just continue to do so over the long term. Those are the winners, not those who just want to jump in and out all of the time. And let me tell you this, the next crisis, the next crash, the next thing that has such a profound impact on your investments is not going to be the same as the last. I mean, this was a pandemic that caused a crash, right? We have seen a housing bubble that caused a crash. That was in 2008, 2009. We have seen a tech bubble that has caused a crash. We have seen, algorithmic trading cause short-term crashes. We've seen all these types. We've seen, the depression. We've seen all these different things that have happened economically and that have happened to our country and that have happened to companies within our country that have caused crashes. But none of them have been the same as the last. So you can almost assure yourself that when you see the market fall next time, and when you hear somebody say that, oh, well, this one is different. This one is going to be a different outcome. This one is going to, we will never come back from this in the stock market. It's not true. We do come back. We have come back. We continue to come back. I am thankful that I took the time to know market history. I am thankful that I knew that when the market has dropped 30% or more, it doesn't have a whole lot further that it falls. The worst the S&P has ever fallen is 55%. So that would be a good little clip from 30. But investing at 30 is going to make you a lot of money moving forward. And it has, and it will continue to do so. So understanding market history is going to allow you to make a lot of long-term profits. And a lot of you have to get this idea of short-term profit making out of your head. Profits are not meant to be made in the stock market in the short term. I know some people do it. Some people even do it well. But a lot of it that is attempted on luck. It's attempted on a feeling. It's attempted on a gut. It's not attempted on fact. It's not attempted on historical data. It's not attempted on, the analysis of companies over time. And that is where value is created in the stock market. Those who trade, they don't create any value. There is no value creation there. I mean, far more people lose when they trade than win. And far more people lose when they jump in and out of the market than those who may ever win. And far more, almost all, lose when they sell their investments amid a crisis. You have to understand how crises occur. You have to understand that moving forward, we may not see another COVID-19 exactly the way it happened. But we are very, very likely to see another situation where the market drops 30, 40, 50%, and you have to be ready. You have to be mentally prepared. You have to be emotionally prepared to say, okay, I am not going to step off of my strategy. I am not going to change everything that I do simply because the market is doing wild things. No, I'm going to continue my process. I'm going to continue investing, continue feeding into my index funds and my mutual funds. And if you do so, then you can look back at a year like 2020 has been thus far, and you can look and you can go, oh, that year had an 11% return. Well, that's cool. And all you'll see is that 11% return. But amidst that 11% return was what? Was a 30+% drop in the stock market. And so that's the thing. If you continue your process and continue to feed your investments over the long term, you'll end up with some really good years out of things that looked really bad. And that's the fun of it. That's the fun of long-term investing, is that things that looked really bad can end up being really, really beneficial to you. So if you have not done this year, I would suggest that you learn more about the market, learn more about investing. Go check out some of my other episodes. Go check out just all the resources that you can about long-term investing, and how you can buy and hold investments for the future and how it will do you so much good. You can build up your emotional tolerance to risk, your emotional tolerance to volatility, and your emotional tolerance to short-term fluctuations in the market in order to build your long-term wealth. So hey guys, thanks for watching this video. If you could, go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below if you haven't done so already. If you're listening on Apple or Spotify podcast, then make sure that you subscribe there and leave me a review. Follow me on social media at MNO with Dylan. And if you want to work one-on-one with me in financial coaching, you want me to walk you through a financial plan and keep you accountable to that plan, then go to my website, www.mnowithdylan.com. Click on the Work with Dylan tab and pick the financial coaching session type that will work best for you. Tune in tomorrow as I talk about COVID-19. I'm going to continue talking about that this week, but I'm going to talk about COVID-19 and debt, and COVID-19 and the importance of not having debt in your life. I think that'd be a really interesting one for a lot of you guys to tune in and listen and just see, what impact can debt have, especially amidst a crisis. So thanks for tuning into this episode of Money's No Object. I'm your host, Dylan Howell. God bless.